biblical times, there was a concept called the second mile theory. If you were not a Roman citizen and the Romans wanted you to pick up, the army wanted you to carry something, you had to go a mile. And there was a guy by the name of Jesus that came and said, if you do the mile, I want you to do one more mile. So a lot of times it's the second mile service. It's going above and beyond. I had a transaction that I started with another title company, small little builder. We did a little private loan to do 12 little lots, struggled with another title company to give us title insurance. So then where did we go to? Picked up the phone and talked to the folks at Pioneer. They have gone the second mile. You can talk to Brenda, and Mike's going to come up and talk. They've gone above and beyond, and I just want to make sure we give them some honor and some thank you. They paid for all the meals. They made it possible for us to be here today. So I'd like to give a nice round of applause to Pioneer. With that said, there's a Pioneer story. I'd like to bring up John Weaver, who will also introduce Mike Dalton from Pioneer. John?
I've been a member of the Pioneer family. I go back 40 years. I was so fortunate to have the founder, beginner of Pioneer Title as my next door neighbor. And I spent a lot of time with this gentleman, not being in, it was just a wonderful experience. And his name was Bob Newland. And I say of Bob Newland was a guy that would say, give me 5 people that changed your life. When I did Bob's eulogy, I said, you people put 5 people's name down that your life changed. When Pioneer came to Tucson, they're all over. They got 77 offices, 800 employees, from Winslow, Arizona to Douglas, Arizona, you name it. Any small community, there's a Pioneer Title. And most of my business was out in the hitherlands. And it was such a pleasure to deal with them. So when it came time to put this market session together, I called Brother Keith, president of Pioneer Title. And he's just opened up here in Tucson, and it's a growing company. So I want to just take and say Pioneer Title is so much part of our community, our state, and they say one thing, commitment to service. Let me tell you what they do. They bring value and they bring trust to your real estate transaction. So without further ado, I'd like to introduce the manager of the new Tucson region, Mike Dalton. Come on.
Thank you very much. We'll give you your speaking fee in the payroll later this week. I'll make this really quick. First of all, thank you everyone for coming out and gaining the knowledge of this tremendous panelists. Thank you for attending. I know this is a hotbed issue that a lot of people are concerned about. Show of hands, how many people make money in real estate? Yeah, this affects all of us. So when we were approached about supporting this, it actually was a little call to from John to Keith, and said, "Hey, can you help us out with this conference we're having?" And from there, it grew tremendously. So we have like 120 people here today, and that was basically on part of the wonderful team that I have here from Pioneer. So if I could have my people in the back, not my people, I work for you guys. The Pioneer team in back, we have Brenda Bowers, who was instrumental in getting all the RSVPs and getting everybody here today. We have Paige Draper, and we have Maru Delgado Moreno, and our escrow officer, newest escrow officer to the company, Sarah Gamble. Sarah, you have a last name. So by you supporting Pioneer, not just here in Tucson, but statewide, it allows us to partner back and put on events like this that bring value to the industry. So on behalf of all the Pioneer employees statewide, I'd like to thank you for attending this conference, and I hope you walk away with a wealth of information. Thank you.
They say approach is everything. When we wanted to do a lunch and learn, we wanted to approach it a little bit differently, and we asked a lot of folks to attend. Wanted to get a great topic, talk about some great things. So with that said, I want to just take a second and introduce our panelists today. And our first one is Tricia Lotzer. Tricia. Mike Flowers, Gary Lotzer, and Troy Rubianis. I know there's a lot of questions, please. And unlike, I'll pick on Gary Andros, he's president-elect of CCIM. This panel will be up there a little bit longer, Gary. And the goal is each panelist will take about 3 to 5 minutes to talk about what's going on in their practice, how the new tax law is affecting their practice, some of the implications, and then better yet, I'll be touching base with Brenda and some of the other folks so we can get some questions out. The goal is to get the questions, have a great interactive Q&A session. At or around an hour from now, we will take a break. I'll ask Blake to take a break, and then some of the folks that are here as our guests for the Lunch and Learns, if you have some properties, you want to do some pitching, we also wanted to have you stick around. I'll have you touch base with Blake and with Tom about, getting up and pitching your properties or some properties that you might be struggling with. With that said, why don't we start off with Tricia. Tricia, come on up to the podium.
Well, first, what a wonderful pleasure to be here, and also what a wonderful surprise to be called up first. Intentionally, I decided not to try to solicit any of the questions or answers beforehand, but hopefully there will be, from the panelists, what I'd really like to hear later is questions that any of you may have or comments. And before I introduce myself, I just want to make sure, it sounds like we've been well covered on thank yous and accolations, but I want to say also thank you for the tree members who made me feel so welcome at this meeting last year. You know who you are. Tricia Lotzer, I'm an attorney, a consultant, a mediator, and also a strategist. I am trained in, obviously, the practice and study of law. I've had the opportunity to do that nationally as well as internationally. And the study of ancient and modern laws is a great passion of mine, not just a profession. And this is all to preface what I plan to contribute to the panel. We have some great tax experts, and I've been in the practice of law 20 years, and I've been a business owner for 10. Actually, longer than that. My first job was when I was a kid. I made up a business. But I want to give you some consolation in my comments today that this new tax law, whether or not it is a gift to us in the industry as real estate professionals, as legal professionals, who here thinks it is a gift, that overall it's going to be a good thing? Go ahead, don't be shy. The Wall Street Journal says you're probably right, but what I want to emphasize in my talk today is that it's also incredibly complicated. So that's the perspective I'm going to be speaking as a lawyer, a strategist on your deals, but also someone who tried to study the actual code of this law. What do I have, about 30 more seconds? Oh my goodness. I tried to read the full text of this law, ladies and gentlemen. They say it's over 1,000 pages, which is, by my translation of the New Testament and my favorite translation of the Tao Te Ching, the tax code is longer than that. And that's, right? What could be that important? And I thought, well, still 1,000 pages. I'm fluent in legalese as anyone. I can still read that. I set aside about 10 days to try to read it. It's just the tip of the iceberg. It's 1,000 pages of referring to other documents. Now, if I were to put that down on the negotiating table and call it a gift to the other side, I'd call that hiding some discovery, maybe obstructing due diligence. So I just want to bring this additional perspective to the panel today, as well as I have done my best to prepare on the tax law itself. And in summary, those of you who want to get one of my maybe collector edition cards, the website's about to change, there's a quote on the back that kind of sums up my perspective on business strategy as well as legal strategy. Anyone here know Miyamoto Musashi? I know some of you will recognize that as one of the ancient samurais. He wrote the Book of Five Rings. In strategy, it is important to see distant things as if they were close, and to take a distance view of close things. So that's part of the perspective I hope to bring today. Thank you.
Hi, everyone. My name is Troy Rubianis. I grew up here in Tucson, started a CPA firm specialized in tax and accounting about a little over 13 years ago. This tax law, like Tricia said, is super complicated. For our practice, I foresee probably less individual returns. The national average for itemized tax returns right now is about 31%. Our software provider is estimating it's probably going to drop to about 5%. So there's going to be a lot of simpler tax returns. It's probably, I would guess, affect H&R Block, some of the smaller end tax preparers. People are going to be able to do their tax return on their own if they're a W-2 employee. However, if you have some complicated stuff, real estate transactions, rentals, 1031 exchanges, you're still going to want to use a professional. I have not read the 1,000-page tax changes. I do attend multiple continuing education classes and will be beefing up again this summer. We kind of pay for those shortcuts, and that's kind of what our firm is for. You know, I've been doing taxes for close to 20 years, and when you come to us, you're paying for a shortcut. Rather than you go spend hours and days reading the tax material and try to figure out 20 years worth of experience, that's what you're paying us for, is you're paying a shortcut. You're getting knowledge and access to 20 years of my brain. And so that's what we kind of use when we pay for continuing education classes on these things and get different perspectives and analysis on the tax code. A few things in the tax code related to real estate. As I was preparing for the meeting this morning, I would point you to the National Association of Realtors has a really nice, they have about 6 examples in there that really spell out how a realtor or an investor, the new tax code compares to the old tax code and what the tax savings are with regards to the business deduction, the 20% business deduction. Very well laid out. What else do we have here? I think if you're an exchanger and you're a 1031 exchanger, they did give us a huge gift with the estate tax exemption. You can essentially just keep flipping properties, exchanging them until you die and avoid tax pretty much forever, because now a married couple can die with $22 million worth of assets and, you know, avoid estate tax and avoid that tax. And if anyone is an employee, you may want to, and you're commissioned or you're in sales, you may want to go to your boss, especially if you're a small business, and discuss maybe being reimbursed for some of your expenses, because the unreimbursed employee expenses are going to be gone. And if you're spending a lot of money driving around in your vehicle or wining and dining clients or traveling, push those expenses up to your boss and reduce your taxable income and reduce your W-2 income. I don't know, how much time do I have left? 1 minute. One of the big changes also coming, hopefully no one's going through a divorce right now, but if you are, the whole alimony deduction is going away, and in the past that's allowed us to really play some strategical planning in order to reduce someone who's, you know, if the spouse is making a lot of money and then the other spouse is getting some alimony, you might be able to reduce one spouse's taxable income at the 39% level and get it taxed down at the 15% level. The IRS basically said, we're not playing this game anymore. So they did give us 1 year to figure it out. So if there's any divorces out there, try and figure it out before the end of the year. So Other than that, it is the largest tax change in more than 30 years since the Tax Act of 1986. And so it is a big change, and there's going to be a lot of education on the CPA side, on the taxpayer side. But luckily we do have a full year to kind of get beefed up on all the knowledge and get ready for next tax season.
I want to mention how privileged and proud I am to be invited to sit on this panel with these three highly capable tax and law professionals. That said, yes, I'm a CPA. I have a license. However, my specialty is not tax-oriented. It's primarily business brokerage, merger and acquisition, business appraisal, and raising capital. All of those require separate licenses. So those are my specialties. And accordingly, when we get to the Q&A session, I will be happy to defer, or perhaps I should say demur, to the two tax CPAs sitting at the table there. And of course, any tax question that is law related to defer to my daughter Tricia, of whom I am very, very proud to join on the panel as well. Probably my greatest accomplishment in life. Everything else is less than. Again, we look forward to an open session, an open dialogue, and hope that we're able to collectively and adequately address all of your questions, whether they are tax or simply business or tax related. For those of you that might have an interest for entertainment benefit, I will have some of my professional profile sheets on the back table there later. And again, thank you for inviting me.
I'm going to skip the intro. I'll be very brief because I already asked the panel to give me a little bit extra time. I'm going to actually go through what a lot of the provisions of the new tax law are, just to set a background, and then when we're done, we'd love to answer questions. So there's a handout that many of you have. If you didn't get the handout, if you would give a card to Brenda, I'll make sure that you get the handout. I apologize, I was short on the number. I didn't bring enough, I apologize. And there's a few up here that can be passed around if you don't mind. My name's Mike Flowers. The accent you may be trying to guess, it's so undistinct, it's New York City, so let's get that out of the way. Okay. I've been doing this since 1976. We're on our 42nd year, so when Troy talks about 20 years of knowledge, I have maybe 30 years of knowledge and then 12 years of like clouds going on. So let's just go to the handouts if we can, and let's talk about what did change and what didn't change. Most of the changes are effective after December 31st, 2017. So the tax return you're filing now, you shouldn't see too many changes, but now's the time to be starting to think about 2018. What everybody forgets to ask, what about the state? Are they going to conform to the federal tax law? It's our educated guess that they've generally done that, but there's been no indication within Arizona what the effects on a state basis are going to be on your 2018 return. But they may make certain exceptions. At one point you had different federal depreciation and state depreciation. You generally know that from the real estate transactions you've been involved in. Let's go to the tax rate change. If you look in the middle of your package, there's a blue sheet that has both last year's bracket and this year's bracket. And I'm going to cut through it for you a little bit. If you made 50 grand, which I hope most of us made more than 50 grand, in 17 your taxes were about $6,600. They're going down to $5,600. So you're saving about $1,000. Again, this assumes everything's identical. If you were 100 grand taxable income, instead of paying $16,500 and 17, you're going to pay about $13,900. So you save about $2,600. At 200 grand, you save about $6,000, reducing your taxes from 43 to 36.5. And at 300 grand, you save about $13,000 in taxes from 74 down to 60. So when they say it's a gift, I think generally you should notice that your taxes decrease. A lot of people say, wait, I don't get to take my children anymore. If you're not taking your children, what they did is they're giving you $2,000 for that child instead of a $4,000 tax exemption. That's almost a 50% tax savings on your child, and nobody was in the 50% bracket. So even those with children should still continue to benefit. They did increase the standard deduction to the $24,000, and we'll go through a little bit of what is and isn't included. Dividends and capital gains are pretty much unchanged, other than how it may affect your tax bracket. Itemized deductions for this year, for 17 and 18 both, it's 7.5% of your income, as opposed to what's traditionally been 10%. So if you have a big medical expense this year, or in 17, it may be more deductible, but to have more, in 19, it's going to go to 10% of your income. So if you make 100 grand, your first $10,000 of medical would not be deductible. Mortgage interest prospectively, and I say again prospectively, on new mortgages over $750,000 will not be deductible. On a personal residence generally. This isn't on your real estate investments and your real estate property. The debt prior to December 15th of 17, so if you had a $900,000 mortgage, you will still be able to continue to deduct that. There's been a lot of confusion as to when it was effective and what the amount is. What they did change, though, is your home equity interest. How much of that is deductible? Zero. So if you have a second mortgage or you have a home equity loan, that loan is now, the interest on that in 18 will not be deductible. State and local taxes, so that's real estate and income tax, has been limited to $10,000. So if you have a $9,000 real estate bill on your house, you'll only be able to deduct $1,000 of the $20,000 that was withheld from your payroll. So that's a combined limit of $10,000. What did they take away, as Troy so accurately told you, is if you're an employee business, if you have business expenses that you've been claiming, a lot of people claim mileage or they take people to lunch and dinner. If you're not the employer and you're an employee, some of the real estate agents, some of the title people, and you're paying for stuff out of your pocket, in 18, that will not be deductible. Moving expenses are not deductible. Investment fees, which is a really big number to some people with a lot of equity, no investment fee deduction. And the little nickel and dime things, the IRA fees and the safety deposit box, you don't have to worry about those anymore. Yes. If you're an independent contractor, truly an independent contractor, then that is not non-employee expenses. Those can still go on your, if you have a 1099, it will support it. If you have a W-2 and you're claiming expenses against your W-2, those are the ones that are generated. That's a good clarification. I appreciate that. And then all CPA lobby somehow was asleep at the job. You're not going to be able to deduct our fees. But if you have a real estate property or a business or anything related to something, we'll bill that entity instead of you, so don't worry about it. Where there's a will. And by the way, I know I will not be stumped today on any tax question. I just want to throw that out there. Because the answer is, it depends. So that you may hear that from us. Have many heard of the 20% pass-through, and is that a concern? My understanding is that your rental property, if it's a loss, it's going to reduce that. If it's income, you may be able to take advantage of the 20%. I have an example. Let's say you have $1 million property not including land. And that's your original basis in the property, not its depreciable basis. And let's say you made 200 grand on that. Generally, the government would say you can take $40,000 off that 200,000 because we're allowing a 20% deduction. That was started because they lowered the corporate rate down to 31%, and they wanted us little guys that don't have corporations. There's not many C corporations in Arizona, so they're giving us a 20% break. So if I had $1 million property and I could exclude 40,000, but that 40,000 is limited by your wages, and in a lot of properties you don't have wages, or 2.5% of the basis in the property. In my case, it was $1 million property, so instead of being able to deduct 40 grand, I'll be limited to 25 grand. If I happen to pay somebody a $20,000 salary, I'm back up to the 40,000. So in some of your real estate transactions, you may want to have wages going out, and if you have management fees, either to yourself or somebody else, if there's some way you can justify those being wages, it may help you get that 20% deduction. Clear as mud? Just as clear as mud to me, man. Affordable Care Act going forward. No individual mandate in 19, but in 18, if you don't have health insurance, they're still charging you $695 per person, or the higher of 2.5% of yearly household income as defined. So for 18, you still need to have health insurance. That was the big controversy. Going to 19, you don't necessarily have to have health insurance. AMT, alternative minimum tax, all you guys are familiar with that, having real estate property. They were talking about eliminating it. They didn't. They've increased the amount before you pay the AMT. And to the extent state taxes are not deductible, that's one of the major reasons that people were in the alternative minimum tax. If they're not deductible, then you just may pay regular tax. If you've been paying AMT, now's a good time to go through the calculation and see if it's going to affect you next year. State and gift tax, Troy mentioned the $11 million. That's each person's allowed to die with $11 million. When I started my career, it was $600,000. 300 apiece, 600 total. Now it's 22 million. That's how the government spends money, I guess. No casualty losses unless you're in a federally declared disaster zone. Troy mentioned the alimony. I mentioned the moving expenses. Those U of A tickets, how many people have U of A tickets? Come on, be honest. Oh, if you have ASU tickets, they're worthless, but. No 80% deduction. You know how the university charges you a fee to get your priority seats? That goes away, which is significant to some people in the Wildcat Club and et cetera. And also they've eliminated the deduction associated with entertainment. So if I take you to the U of A game and I didn't pay a priority, I can't write off that ticket. If I take you to a meal before the game, I can probably write off that meal. If I buy you a meal at the game, I probably can't take that meal because it's in connection with entertainment. So anything in connection with entertainment, you don't get the deduction or the related costs. But if you go to a lunch, take somebody to lunch, we're still of the opinion that that counts. They haven't done the clarification of all the rules.
So what about those sport boxes at the professional games that they have? You're basically saying
Everybody's getting whacked.
that's in question. Okay.
That's
Wow.
a whack. The thing to be considering, and some of you may have had this situation, if you're in 17 and I owe 100 grand at the end of the year, as you go into 18, that number repeats itself for your estimated taxes. So you may want to take a look at, do I need to make $25,000 quarterly estimates, as opposed to, geez, my taxes are going to go down to 80 grand, why don't I send them 20 grand a quarter? As a safe harbor, if you owed 100 in 17, you think you're going to owe 250 in 18, then you may want to pay in about $110,000, and there'll be no additional interest and penalties on the difference as long as you pay it by April 15 of 19. So that's the general background that we're talking about. I think from my perspective, I see this as a gift. It's an especially good gift if you plan for it and don't just happen to back into it. If you're working with the CPA, and have been working with the CPA throughout your career, now's a good time. Not now, but probably May 1st. I'd give him a call and sit down and what can we do. If you're working with a non-CPA, it's at your own risk. And Troy and I believe 100% in using CPAs. Both of us had to go to college. Both of us had to have 40 hours of education every year. We're the only ones regulated by the state board. If we screw up on something, the State Board of Accountancy can get involved. If you're a non-CPA, there's no jurisdiction on the non-CPA. I always joke my wife could be a tax preparer, and she knows as much about tax preparing as I do about taking care of the house in some situations. So the CPA is the stamp of approval, sort of like doctor, lawyer, we're all professionals. And if you're not using a professional going forward, now's the time to really think about that. It's 1,000 pages. We just spent $2,000 in our office listening to a guy in North Carolina for 8 hours because he's the national expert, Don Farmer. And we invested $2,000, and I had a staff come in at 6 in the morning because he was talking in North Carolina. Okay. And we just started to tip the iceberg.
The gentleman that just spoke, you mentioned that 20% pass-through deduction.
Yes.
Where does that appear on the 1040?
It'll be in 2018. And each business calculates what's eligible separately, and then it's a combined number.
So will it apply to Schedule C, the self-employment schedule?
It may.
Okay.
My understanding is it does apply to Schedule C, but if you have a rental, I make $100,000 on my Schedule C, I lose 20 on my rental, I may only get a 20% deduction on $80,000.
And then the second part of my question relates to, I went to a breakfast the other day, and an investment counselor mentioned that single sole proprietors should consider converting to
An
a
S corp.
one-member LLC.
No, a single member LLC by definition is a Schedule C. What a single member LLC or a sole proprietor should be seriously considering if they're making income is to elect to be taxed as a subchapter S corporation. In that situation, let's say I sell shoes and I make $200,000. When I do my tax return as a Schedule C, I not only pay income tax on the $200,000, but I pay an additional 15.3% for self-employment tax, up to the max of about $125,000. So I'm paying an extra $18,000 in self-employment tax. If my brother owned the same shoe company and he was an S corp and he paid himself $50,000 and everything else was a profit, he would only pay self-employment tax on $50,000 instead of $200,000. It's a terrible mistake to be a Schedule C showing income, more than $30,000 to $40,000.
Some time being afforded us to get the conversion done over to the S corporation.
If you had a single member LLC, my thoughts are that you can elect by March 15 for 18 to have that Schedule C taxed as an S corp. If you're just a sole proprietor and never formed an LLC, if you elected on March 1st, your first 2 months would be a Schedule C. Your next 10 months would then allow you to be taxed as an S corp. So you'd want to have some strategy to push the income into the S corp as much as possible.
Sean, you got
so
one?
you're not exposed.
We
to
got
some-
one back here, Mike.
Sure.
And these questions are coming from a webinar through an IRS tax auditor, and he shared with us that there is a tax law that allows you to write off $2,500 per item, if you're remodeling. In other words, if you buy a $2,500 refrigerator, washer, dryer, you need to report them separately, but you can write them all off. No?
Prior to 2017, those of you that owned a number of individual rentals or residential rentals, when you bought the refrigerator for $1,000, you would like to expense it, but then your CPA comes in and says, wait, we have to write this off of 5 to 7 years. With this new tax law that's much more favorable, now you can expense those items. And generally, if you're doing a remodel of what's traditionally known as furniture and fixtures and movable walls and the cost segregation type items, those items will generally qualify for up to $1 million worth of Section 179. Section 179 is the code section that allows you in year one to write off that property.
Okay.
Be careful, though. I was talking to a gentleman at lunch. There's this concept called recapture.
Is it?
You're the guy. Yeah, and you have to be careful because then that property or that particular asset has a zero basis to you. So you just need to be cautious.
Many times in the exchange world in real estate, properties are held in an LLC. Single proprietor sometimes, sometimes not. What we've done in the past is we trade LLCs. It's like kinds, personal property. Has that gone away?
Personal property or real property?
No. I got a piece of real property. It's all over this room today.
Right.
It's in an LLC. It's the only asset and its only liability is that property in that LLC.
Right.
Over here's a guy that's got another LLC. His only personal asset in that LLC is that personal asset. I don't want to trade that real estate for this man's real estate. I want to trade his LLC and he take my LLC.
I have a point on that, John. In addition to what the gentlemen are going to add from the tax perspective, the single member LLCs come up a couple times. And taking a step back a minute just from the financial implications, you're all from different states. I recognize this is a national conference. In Arizona, this hasn't been a legal issue yet, but state courts in Colorado, I believe Florida, have disregarded single-member LLCs for certain types
Okay,
of
suppose
liability
then
protection.
It's not a.
Oh, I'm not even disagreeing with you. What you raise is an excellent idea, and I'm getting around to that,
Okay.
which is that if you are trading, from a legal perspective, if you are trading the LLC for another LLC, you are potentially trading the liabilities of that LLC as well.
I agree.
And sometimes that can eclipse the appraised value. But otherwise, John, I'm totally on the same page. I get it, and now I'm anxious to hear what the tax guys say.
So in your opinion, I can still trade that LLC for an LLC. The only liabilities and in that LLC is there, and I trade my LLC for another LLC. I guess my question, again, would be, might you suggest we move that LLC to a C Corp or an S Corp, excuse me?
I'm not sure I would change the entity structure, but let's say your LLC was $1 million property with $800,000 in depreciation.
Okay.
And you got a $200,000 basis.
Okay.
You may owe $600,000 on
I
the
could.
property and only have $400,000 equity.
But if I take your LLC.
Right, but wait. Now my property is $1 million property with $10,000 worth of depreciation,
Mhm.
and I owe $100,000 on it. I'm not sure what the.
The advantage is I traded my LLC to your LLC.
But you're going to have to give me some cash or something.
Maybe.
Right.
Maybe.
Right.
Maybe
Right.
not.
Right, but that would even it out. And then if you exchange the LLC, I believe you inherit my depreciation schedule and what I got
But
going.
this new tax law does not say anything, Teresa, that says we can't do that.
There's no regulations that have come out other than the tax law. Normally there's a tax law, and then after they put it in real broad strokes, then you get regulations saying in an LLC with more than 2 members, blah, blah, and more than 5 members.
Can I
et
take
cetera.
my S Corp and trade it for another S corp. All assets and liabilities in mine, and all assets and liabilities.
I don't think S corps are eligible for like-kind exchanges.
Why? It's
Mike, can
personal.
I add something to
It's
this?
personal
The
property.
new tax laws, I think, got rid of all like-kind exchanges. The new tax law got rid of all like-kind exchanges other than real property. So there's no personal property. You can't trade a cow for a cow, a truck for a truck. From my understanding of the law, it's real estate only is
Let me
the
get a-
only thing allowed under the 1031 exchange law.
Let me get a
going
couple
forward.
more questions in. Gary?
Okay, when I own real property, I put it in an LLC. That real property generates revenue. Okay, it also has expenses. For example, it has property tax, it has repairs and things of that nature. How does the new law look upon it, and how does it, when it trickles down to me on a personal level, how does it affect me? For example, the $10,000 cap on real property.
The rental properties, virtually nothing will change other than your taxable income will change based on the new tax brackets. I mean, your taxable income will be the same, but you'll just have a different tax amount because of the new tax brackets. The only thing you really need to be aware of is if you have land or investment property that's just sitting still and you're trying to deduct the real estate taxes, which flow through to Schedule A, you may want to consider capitalizing those real estate taxes into the basis of the real estate, because you'll probably lose that real estate tax because of the $10,000 limitation on Schedule A. Yeah, the LLC doesn't matter on you have to think of legal as one silo and taxes in another silo. The LLC is how you're incorporated, how you're looked at for legal in the state of Arizona, and then taxes is a whole different silo that things are happening in.
That 10,000 doesn't apply to the real estate. If you have a real estate property with $15,000 in real estate tax, you deduct $15,000. I hope everybody's clear on
Only
that.
if it's a rental though, right, Mike? If it's just raw land, you'll lose that.
If it's in connection with a rental property, that's not limited to the $10,000. And if it is a piece of land, if your real estate taxes were passing through out to you personally, then they may have an effect on that. But your typical rental property, the 10,000 is not what they were gearing towards when they changed it to 10,000. It's on a personal basis, your personal house and your personal state taxes.
This is Section 121, exclusion of gain on sale of principal. Do you know what they're thinking? It says that
It was supposed to, there was 2 out of, if you make more than $250,000 as a single person, or more than $500,000 as a married couple on the sale of your principal residence, there was an exclusion for that. In the tax law, they were changing, instead of 2 out of 5 years, 3 out of 7, 4 out of 8, 5 out of, they went back and forth on that. My understanding is that in the new tax law, they left it at the 2 out of 5 years. So you don't have to be in your personal residence. That's what they were talking about, but I think they went back.
Yeah,
to
Mike's correct. They were thinking about changing it to 5 out of 8,
They never did.
and they never did. It's still at 2 out of 5.
So that's the gain on your personal residence. California has more of a problem because they have higher appreciation than we do. Not a lot of people make $500,000 on their house in Tucson, generally.
I'm always trading at fair market value. I'm not trading at my basis, but the only way I can really add to it is to add money. It's the only way I can up my basis, but I can't sell any of my properties, and I own a lot of properties. I've been dealing in farms and ranches, and I really get accelerated depreciation.
Everybody knows the good side of a tax-free exchange. What happens? You don't pay taxes. So if I had a property that I paid $100,000 for and I sold it for $1 million, or I traded it to you for $1 million, and I did get $1 million worth of property, my basis is $100,000.
I understand that. So how do you increase it? You have to add some cash to a deal.
Cash is,
How else
cash
do
would give you
You
more
can-
basis than that.
That's the only way I can
You
increase
can die.
the
If you
basis.
die, you increase your basis.
When you die, it gets stepped up,
Well,
unfortunately.
I don't feel like dying tomorrow. You know.
We're talking tax planning here, now you gotta cooperate.
I do commission sales. I run all my income through my PLLC, and my other accountant told me to pay my LLC S Corp a management fee, and then write off all my expenses through my S Corp.
Absolutely.
So my PLLC only takes in income. It doesn't have any other expenses. It doesn't do anything else. Occasionally, it might pay for some education related to a license.
What if, so if one person owner dies, then you get, and there's two of them, you get half of the value stepped up, correct?
If I'm a 50% owner, if I'm a 20% owner in a $2 million property, my basis gets stepped up to 400 grand.
Okay.
It's easy if you do 20/80 instead of 50/50.
Well, question.
Right.
So, do they have to own it very long? In other
No,
words,
it's when you die, and
in other words,
this-
say I own properties, and my husband's in worse health than I am in, and I put him on my properties, and he dies before me. Does he have to be alive own him a certain amount of time, or
No.
I can just put him on, and next week he dies, and I get a stepped-up basis?
he's theoretically on your property as a 50% community property owner, unless you had sole and single property.
Okay.
So by definition, he has a 50% interest. If he dies, God forbid,
Or if I get
both
married,
both
say-
sides get stepped up.
so
It's
if I
not
get
just his
married
half.
late in life and he only lives a few years, do I still get a stepped-up basis?
Yes, if you outlive him.
Yay.
And this is just, I'm Blake Allen, I'm the meeting manager here with the exchange meeting, and just what I always, when I have licensees who don't know about exchanging, I'll tell you straight out, you know, myself, on my own personal sales, I'm on pace to do $20 million this year, and 90% of it's out of these groups. You'll never go sell another house to an owner occupant again after you've done this for a few years, except people who are clients. So you can change your life by staying in this room, or you can go and keep doing business as usual.
Gary,
Okay, I think didn't I owe you a comment, Gary? Go ahead.
and then one.
Yep, and then Mike, then we'll cut it off.
Okay. Billy, thank you. I just wanted to very, very briefly circle back to John Weaver's question with regard to exchanging one LLC, in other words, an entity for another entity. And Mike and Troy have tried to address the tax implications as to whether that qualifies under 1031 or perhaps some other section of the code that's exchange related, because 1031 is primarily or exclusively, you know, real estate related. The point I want to make, John, I'm glad you got back in the room here, is that we need to keep in mind that what was really being exchanged there is ownership in the LLCs, not the properties that reside within the LLC. So in that regard, you're trading a security for a security, not real estate for real estate. And quite frankly, to establish the values that are being exchanged, you would actually be valuing the 100% ownership interest in those LLCs. Very important distinction, because that changes the nature of the assets that are being exchanged.
I'm not clear on a real estate transaction that's in an LLC being exchanged for the ownership of the LLC. The like kind was generally real estate for real estate, and I don't know that the LLC allows you to wrap it. And I just don't know that. I can certainly get back to you, or I'll get something to Mark or Billy so that you guys will know that. But I'm not sure that you can trade LLC for LLC on a 1031.